You know what? 90% of beginners in the stock market lose money. Yes, you heard right. Almost everyone. And yet, here you are, ready to learn how we part of the 10% who actually win. You might be thinking, but the stock market, it's reserved for the rich, the experts, those who know all the tips and tricks. Well, think again. It's not a closed club, nor a game of chance. The stock market can be accessible to anyone, provided you know where to put your feet and how to move forward. Imagine for a moment. You see all these articles about astronomical fortunes, young millionaires who won everything with a click of a button. Tempting, right? But the reality is that most of these stories are exceptions, lucky breaks. And if you go into it without a strategy, you risk lose your savings, your energy, your morale, everything. What I'm going to show you today is how to avoid these traps. How to invest smartly, not by playing roulette with your money. By the end of this video, you will know the 3 fundamental rules for investing in the stock market without breaking the bank. 3 simple yet powerful rules. If you apply them correctly, they will transform your way of thinking about investing. You will understand how to protect your capital, how to choose your investments, and, above all, how to make your money work for you without unnecessary stress. So take a deep breath. Get ready to write down, because what you're about to learn now might just be the beginning of your success in the stock market. And trust me, you'll never look at the stock market the same way again after this. Rule number 1. Never invest more than you can afford to lose. Before putting a single cent into the stock market, you must understand a fundamental rule that too many beginners ignore: risk management. Because you can have the best strategy, the best action, but if you put all your money in the wrong place, you can lose everything in an instant. And believe me, it happens more often than you think. Picture this. You just got your paycheck, paid the rent, paid the bills, put a little aside for groceries, and have a little extra left over. You think to yourself, what if I invested it all in the stock market? After all, it might be my ticket to getting rich quick. And then you put 100% of what you have left on a single action, without thinking, just because a friend told you it was going to go up. Result? The stock drops 30%, 50%, and within days, your little extra disappears. Disaster strikes, and not only is your money gone, but so is your morale. You feel this terrible anguish, that regret that makes you say to yourself, why wasn't I more careful? This rule exists exactly to avoid this type of situation. This is where the concept of money management. The idea is simple. Never put more than a small percentage of your capital on a single position. For example, only 5%. Why? Because even if the investment fails, you still have 95% of your capital intact to continue investing, learning, and growing. This is exactly what professional investors do. They never bet everything on a single shot. They know that the stock market is a marathon, not a sprint. And you know what? Respecting this rule also means keep calm and confident. If you invest prudently, you won't panic when the market fluctuates. You can analyze, adjust, and make better decisions. And most importantly, you protect yourself from irreversible mistakes. To give you a concrete example, imagine 2 friends, Mark and Sophie. Mark puts all his small capital into a single stock because he wants to get rich quickly. Sophie, on the other hand, divides her capital into small portions, a few stocks here and there, with a small portion in ETFs for diversification. When the market drops sharply, Mark loses everything, while Sophie just sees a temporary decline in part of her portfolio. She can wait, analyze, and continue to invest intelligently. The difference? The risk management and discipline. So I ask you the question, Would you be able to lose your entire salary on a single bet? If the answer is no, and it should be, then start applying this rule now. Invest small, protect your capital, and move forward step by step. This first rule is the foundation of your success in the stock market. Without it, even the best strategies collapse. With it, you lay a solid foundation for learning, progressing, and above all, don't get crushed by the market. Rule number 2, understand what you are investing in. You see, investing in the stock market isn't like buying a baguette or a smartphone. Here, every decision can have a direct impact on your money and therefore on your daily life. That's why understanding where you put your money is absolutely essential. Too many beginners rush in head first, without ever asking the right questions, and find themselves trapped. So let's start with the basics. There are different types of stock market investments, and each has its own specificities. The actions. These are shares in a company. Buying a share means becoming owner of part of this company. If it does well, you can make money from the price increase or dividends. But if it fails, you lose. Simple but demanding. Les ETF, exchange-traded funds. These are baskets of stocks or bonds. They allow you to diversify your investment automatically and therefore reduce risk. Perfect for beginners who want to avoid putting everything into one company. The obligations. These are loans that you make to a company or a state. Less risky than shares, but the gains are often more modest. Cryptocurrencies, volatile and risky. Some see it as great opportunities, others as traps. The key here, never invest without really understanding how it works. Now, let's look at a concrete example. Let's imagine that you want to buy shares of a company called Teknova. Before clicking buy, you should ask yourself these questions. Is this business profitable? What is its financial history? Are their products or services in demand? How does it compare to its competitors? This is exactly what we call analyze a business. Even a quick glance at its financial results and market position can save you from big losses. But many people don't know this. They blindly follow the advice of friends or social media. This stock is going to explode, buy now. The result? When the market falls, they find themselves with a losing portfolio and zero understanding of what happened. To give you an anecdote, there was this young investor, let's call him Alex. He heard about a promising startup on Instagram. Everyone was saying, "It's going to take off, go for it." Alex put a large chunk of his capital into it, without ever looking at the accounts, the competitors, or the product. A few weeks later, the startup failed, and Alex lost almost half his money. The lesson? Knowledge is worth much more than free advice from social networks. So ask yourself this question. Do you really know what you're putting your money into? If the answer is no, take the time to learn, read, and compare. Even 10 minutes of research a day can make a huge difference in the long run. Remember, in the stock market, haste is expensive, and patience and understanding pay off big. Understanding what you're investing in is like put on a parachute before jumping. You reduce the risk and you can enjoy the flight safely. This rule is your shield against beginners' mistakes. Without it, you expose yourself to avoidable losses. With it, you invest with full knowledge of the facts and turn every decision into an opportunity, not a stressful one. Rule number 3. Patience and consistency always pay off. Do you know what separates successful investors from unsuccessful ones? It's not just stock selection or luck. It's patience and regularity. Yes, it's that simple and that powerful. The stock market is not a casino where you win or lose everything in one day. It's a marathon. And those who win are those who go the distance. Imagine you decide to invest 50 euros per month. Does that seem like a small amount to you, not enough to change your life? What if I told you that on 10 years, with a reasonable average growth of 7% per year, these 50 euros per month can turn into almost 8,500 euros? And that's just a small example. Imagine if you gave your salary a little raise every year, or added a bonus every now and then. The magic of time and compound interest would do the rest. This is exactly what we call strategy. Buy and hold. Buy quality stocks or ETFs and keep in the long term, even when the market fluctuates. Because the market, by nature, goes up and down. There will always be days when you want to sell out of fear or buy frantically out of FOMO, that fear of missing out. But reacting with emotions is expensive. Panic sales, impulse buying, it makes you lose more than you could gain. To give you a concrete example, let's take Sophie, a novice investor. She started with just 50 euros a month in an ETF that tracks the market. At first, she watched the fluctuations every day and felt like selling everything when it dropped 5%. But she decided to hold on, to continue her monthly payments. 10 years later, not only had she accumulated a nice sum, but she had also learned to stay calm and trust the process. Patience and regularity are also a question of mental discipline. Saying to yourself, I know I'm not going to get rich overnight, but I'm building something solid and lasting. And believe me, that feeling of security and control is priceless. So remember this: invest regularly, even small amounts, will always beat a rapid speculation, the whims and the miracle advice that you can read everywhere on the internet. Every little step counts, every month counts, and every year counts. With patience and regularity, you transform your capital into a real value-generating machine. And now I ask you the question: are you ready to implement this discipline for your financial future? Because if you start today, even modestly, in 10 years, you will thank me. And that is the true power of the stock market. Time works for you, not against you. Mistakes to absolutely avoid. Before you continue your stock market adventure, there is something important you need to understand. The stock market can reward you, but it can also punish you very quickly if you make the wrong choices. And some mistakes are so common that they cost beginners thousands, even tens of thousands of euros. Today, I'm going to show you the pitfalls to absolutely avoid, so that you don't fall into the same hole as so many others. The first and most classic mistake is put all your money into a single stock or sector. Yes, it may seem tempting. A stock that promises huge returns, a booming sector. But if it collapses, you lose everything in the blink of an eye. Imagine someone putting all their savings into a single tech startup. For the first few months, it's a dream come true. Then a competitor comes out with a better product, and the stock plummets. The result? Tears, stress, and zero capital left. The second error is related. Neglect diversification. Diversify is a word you'll hear over and over again, and for good reason. It reduces the risk of losing everything, stocks in different sectors, ETFs, bonds, even a little cash. All of this spreads your risk. Those who ignore this principle end up with fragile portfolios. One bad news, a market crash, and all their capital disappears. And then there is the error of tips and promises of quick profits. You know, those messages you see everywhere. This stock will explode tomorrow. Invest now and become a millionaire. These tips are often disguised traps. Even if it works once, you can't build a solid strategy on speculation and rumors. Too many beginners rush in, buy without analysis, and lose their money in a few hours or days. To give you a concrete example, there was Lucas, a young investor who followed all the good deals on an online forum. Every week, he bought the new recommended stock, sometimes putting a large part of his capital into it. After a few months, he had lost more than half of what he had invested. His fault? He had no strategy. He didn't know the companies he was investing in, and he believed in easy promises. Another anecdote. Marie, an enthusiastic beginner, put everything into the green energy sector because she was told it was the future. Then a regulatory change caused all the stocks in the sector to plummet. Her portfolio plunged 40%. Had she diversified, some of her money would have been protected. So remember, never put all your eggs in one basket. Diversify. Analyze. Ignore promises of quick profits. The stock market is a game of patience and strategy, not luck and haste. These mistakes may seem simple to avoid, but they are the cause of the majority of beginners' failures. If you want to succeed in the long run, start by protect yourself against them. And trust me, your future self will thank you for learning these lessons before you waste your money unnecessarily. Practical example. The story of Thomas, a beginner in the stock market. Let me tell you the story of Thomas, a young beginner like you, who wanted to get started on the stock market for the first time. Thomas had heard lots of stories of people getting rich overnight, and he thought it was easy. So he took his small capital and did exactly what you should never do when you're starting out. He put a large portion of his money into a single stock, because a friend had told him, this one is going to explode. At first, it went up a little. Thomas was euphoric. But a few weeks later, the stock dropped sharply. Panic, stress. Thomas sold in a rush and lost almost half of his capital. He said to himself, the stock market is too risky for me. But instead of giving up, Thomas decided to change approach. He started learning. He read articles, watched videos, and most importantly, he understood the importance of the 3 essential rules that we saw. Never invest more than you can afford to lose. Thomas started investing only 5% of its capital on each position, thus protecting the rest of his money. Understand what he is investing in. Before every purchase, he will analyze the company, its sector, its competitors, and its financial results. He understands that knowledge is his best protection against unnecessary losses. Patience and consistency always pay off. Thomas put a plan in place. Invest a small amount each month, hold his positions for the long term, and not panic when the market drops. At first, it wasn't easy. Seeing his investments fluctuate always caused him a little stress, but he learned to no longer react with one's emotions. He understood that the stock market was not a casino and that consistency, even with small amounts, would eventually pay off. A year later, Thomas had restored his lost capital and even earned a little more thanks to his discipline and thoughtful choices. He didn't become a millionaire overnight, but he saw his efforts paying off. He felt more confident, more informed, and above all, ready to continue in the long term. This story is exactly what I want you to take away. Mistakes happen, that's normal. But what matters is learning, applying the rules, and staying consistent. With patience, discipline, and knowledge, every little step counts. Thomas started with little, but with time and consistency, he transformed his approach and built a solid foundation for the future. So look in the mirror and ask yourself, are you ready to become like Thomas? To learn from your mistakes, invest wisely, and let time work for you? Because if you do, you'll be surprised at what you can accomplish, even with small initial investments. So here we are. We've come to the end of this video. But before we let you go, let's get back to the essential points that you absolutely must keep in mind if you want to succeed in the stock market. Rule number 1, never invest more than you can afford to lose. This is the basics. Your capital must be protected. If you follow this rule, even if a position fails, you can continue to learn and progress. You will never find yourself completely stuck or ruined. Rule number 2, Understand what you are investing in. Never trust quick advice or promises of easy profits. Analyze companies. Look at the numbers. Understand the industry. Knowledge is your shield against avoidable losses. Investing without understanding is like sailing at sea without a compass. You risk running aground before you even reach your goal. Rule number 3. Patience and consistency always pay off. The stock market is not a game of chance. It rewards those who invest little by little with discipline and who remain consistent over time. Even modest, regular investments, applied over several years, can yield impressive results thanks to compound interest and market growth. If you combine these 3 rules, you pose the solid foundations for your financial success. And remember, discipline is your best friend. It protects you from impulsive decisions, rash decisions, and panic when the market fluctuates. It transforms a hesitant beginner into a confident investor. Now I want you to think seriously about this. What first stock or ETF will you study today? Not tomorrow, not next week. Today. Even a small step, taken with thought and consistency, brings you closer to your financial goals. It's this consistency that separates those who dream from those who succeed. And before you go, a little practical advice. Start keeping a notebook or a table, track your investments. Record your decisions, your reasons, and what you learn at each stage. This will help you stay disciplined, measure your progress, and improve your choices each time. If this video has helped you see things more clearly and feel ready to invest intelligently, don't hesitate to like, comment, or subscribe to stay up to date on upcoming practical tips. Share your first investment in the comments. It can inspire other beginners like you and create a real community of thoughtful and disciplined investors. Remember one last thing. The stock market is not a race against others. It is a race against time and against your own past mistakes. Apply these rules. Stay patient, keep learning, and most importantly, stay consistent. With the right strategy and discipline, you can turn every small investment into a solid step toward financial independence.